everyone, welcome back to the Investing Iguana. In today's video, I'm excited to share insights on share buybacks. You might have wondered why major Singapore companies like DBS are spending billions on them lately. By the end of this video, you'll understand how buybacks work and whether they're good for your investments. So, let's dive right in. Hey friends, I'm Iggy, your friendly neighborhood finance guru. For those new here, I've been covering Singapore stocks, CPF, and wealth-building topics for over 5 years. I'm proud to say that the Investing Iguana has now been ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I'm thrilled to have such a supportive community and look forward to sharing more valuable content with you. DBS's massive buyback. DBS just dropped a bombshell announcement, a $3 billion share buyback program. The market's response was immediate, with the stock hitting an all-time high of $42.40 on November 7, 2024. Investors are clearly excited about this news, and for good reason. This move marks a first for DBS, as they'll actually be canceling the repurchased shares instead of just holding them. So, what exactly are share buybacks? Let me break it down in simple terms. Imagine you own a pizza shop with 9 other partners. If the shop buys out one partner's share, what happens? The remaining 9 partners now own a bigger slice of the same profitable business. That's essentially what happens in a share buyback. The company buys back its own shares, reducing the total number of shares outstanding. This increases the ownership stake of remaining shareholders, making each share more valuable. It's like getting a bigger slice of the pizza, and who doesn't love that? The global buyback trend. Share buybacks aren't just a Singapore phenomenon, they're a global trend. In fact, in the first quarter of 2024, S&P 500 companies spent a staggering $236.8 billion on share repurchases. That's a massive amount of money being invested back into companies. Some companies are leading the charge in share buybacks. Apple, for instance, has bought back an incredible $663.9 billion in shares over the last decade. That's a significant chunk of change. When interest rates are heading lower, companies often choose to invest in themselves through buybacks rather than keeping cash in the bank. And with the Federal Reserve expected to cut rates soon, we might see even more companies jumping on the buyback bandwagon. DBS's strategic move. DBS CEO Piyush Gupta has made a clever move with this share buyback program. Even after spending $3 billion on buybacks, the bank will still have a significant war chest of about $6 billion in excess capital. This demonstrates incredible financial strength and smart capital management. It's like having a safety net, while still investing in the company's future growth. But that's not all. History has shown that companies that do buybacks often see strong returns. Take the CIBC US Buyback Index, for example. It returned an impressive 21.47% for the fiscal year ending July 31st, 2024. Outperforming the S&P 500's 20.34% return. That's a significant margin. This data suggests that companies that invest in themselves through buybacks can generate substantial value for their shareholders. It's like getting a boost to your investment portfolio. The downside risk. Now, let's talk about the potential downside of share buybacks. While they can be a great way for companies to invest in themselves, timing is crucial. If a company buys back shares at peak prices, it can be a poor use of capital. For instance, as of November 14, 2024, DBS trades at $42.66 near its historical high. That's a pretty pricey buyback. For investors, share buybacks can be a double-edged sword. On one hand, they can boost share prices and earnings per share, which is great for investors. On the other hand, buybacks might also indicate that a company can't find better growth opportunities. That's a concern, as investors want to see companies investing in their future growth, not just propping up their share price. It's like a balancing act. Companies need to use their capital wisely and make smart decisions about when to do buybacks. Possible lack of better investment opportunities. One red flag is that the company may not have profitable opportunities to invest in, which could be a concern for long-term investors looking for capital appreciation. Maybank research analyst Jarek Seat notes that share buybacks could indicate inefficient cash usage or limited growth. Paragon's Lee adds that a company buying back shares may suggest they haven't found better investment opportunities. It's all about business management, and companies must weigh their options carefully. Phillips Securities Chu agrees, stating that the value of buybacks depends on timing and valuation. When done correctly, buybacks can improve financials and return capital to shareholders. However, companies should be cautious when buying back shares at high valuations, especially if they borrow to finance the scheme. Not all industries or companies are well suited for buybacks, and it must be balanced with the company's ability to access capital. Chu warns that companies should be mindful of their financial situation and make informed decisions about share buybacks. Looking ahead. So what's next for DBS? Despite the large buyback, the outlook remains strong. The bank expects to maintain healthy capital levels and continue growing its business across Asia. That's great news for investors and a testament to DBS's solid financial management. And here's an interesting trend to watch. With global interest rates expected to decline, we might see more companies following DBS's lead and doing buybacks, especially companies with large cash reserves who might find returns on cash deposits less attractive. This could be a smart move for companies to return value to shareholders and optimize their capital allocation. Let's keep an eye on this trend and see how it plays out. Thanks for tuning in to this deep dive on share buybacks. If you found this video helpful, please show your support by hitting that like button and subscribing to the Investing Iguana. Your engagement means a lot to me, and it helps me create more content to help you on your financial journey. And if you're interested in learning more about the banking sector, check out my recent video on DBS versus OCBC versus UOB, where I break down the latest financial results from these three banking giants. You'll get a better understanding of their financial performance, strengths, and weaknesses. It's a great resource to help you make informed investment decisions. Go check it out. To help you on